Hi, welcome to this Zoom session. I'm going to talk about the launch of the Centaur BCI SA Equity Fund. It's pretty brief. We're going to have questions and answers afterwards, but let me run through this. Just a quick overview on Centaur. Centaur was founded in 2000, so we've been going for over 23 years. And Centaur was founded with three guiding principles: to deliver investment excellence. And if you see our performance of the flexible fund, number 1 over 10 years, our balanced fund, number 2 over 10 years, we are delivering on this mandate. The second principle, really outstanding service. We believe our clients need responsive service, and that's what we aim to deliver. And without a question, we conduct our business with the utmost integrity. And the objective on the foundation of Centaur was to be the best retail asset manager in South Africa. And it is my belief, if we can deliver on these principles over the long term, we should be able to do this. We manage retail-only assets. That means we have no institutional funds under management. And consequently, we are slightly smaller because we choose to focus our stock picking skills on a smaller pool of assets. At the end of October, we had 7.2 billion of assets under management. We've got a tightly knit team with select members getting profit share. Just looking at our performance, we're particularly proud of this. And there's a lot of work in the back end to make sure we continually to deliver excess performance after fees. Over 3 years, the flexible fund is 9 out of 64. You can see the returns: 5 years, 2 out of 48, and over 10 years, 1 out of 32. Over the short term, it's hard to be number one all the time, but over the long term, your alpha generation and your skill manifests, and it's very nice to see consistent top-ranking performance over 5 and 10 years. Our balanced fund's been running for just over 10 years. You can see over the 10-year period, we're number 2 out of 84 and 9 out of 175. What's also very pleasing to report is we top decile in all these periods: 1, 3, 5, and 10 years. So the question really is, why were we launching a South African fund? I think most importantly, we are South African specialists. We know the market backwards. We have a lot of relationships with CEOs. We know the DNA of the companies, and we have the expertise to deliver. We have the systems, we have the knowledge, and experience to deliver. We also think things are looking up slightly for South Africa. We've been through a difficult period. I think the Zuma period was exceptionally difficult. Post-Zuma, Ramaphosa has improved the mood, but he did inherit a legacy of a lot of bad issues, and we see better prospective returns for South African equities going ahead. We think the returns are going to be very good, and consequently, it's going to be a very compelling product for our clients. We also, the way the industry has evolved, financial advisors look for specialist equity blocks. So they'll look at a fixed interest solution, a South African equity solution, and an offshore solution. We see a very big market for the South African equity building block, and we look to get our share of this demand. Also, it's going to improve our breadth of products. Centaur's really got two products. This is really the third. In time, we're going to look at launching an offshore equity fund, but it's really just improving the diversity of Centaur's product range. Our investment philosophy, we call it dynamic value creation. And what does this really mean? It means we see a company or an equity as a value-generating entity. So if the equity risk premium is 13%, we'll look for the company to deliver over the medium term 13% returns. And we really look at the management's actions to deliver on that. And good management can take a mediocre business and create value for shareholders. So really the four elements is strong management who are realistic and understand their competitive advantages. We also look for a reasonable business. So that means a relatively high return on capital and ideally recurring revenue streams. Also, good management evolve this business and consequently over time they grow value. The second element, we also look to buy a share that is slightly undervalued, but I think our preference is first for a growing business which is delivering a value over time, and secondly, we're looking to buy it in an undervalued state. Just to give an example how this has worked, and we have deployed it into the fund, we bought RMI Holdings in June 2011. This unbundled from RMB Holdings, and when we looked into this opportunity, we saw an exceptional situation arising, possibly the most sure thing investment opportunity I've seen possibly ever. And really the key asset there was OUTsurance. It had outstanding business characteristics, a very high return on equity of over 30%, great cash flow, and revenue growth of over 20% per annum. Also, the backers were proven value creators, the founders of RMB, and consequently, Centaur bought a 10% holding in the Flexible Fund in June 2011. So that was our insight. Let's look how that investment has turned out. We still do own some OUTsurance. So OUTsurance, in the period subsequent to that, grew gross written premiums at 14% per annum. In a pretty slow economic growth over the last 10 years, 14% per annum is very credible. And the success, they've had outstanding success. They transported their business model to Australia with the operation called We, and that now comprises 43 of gross written premiums. And they've also established further new growth nodes in direct life in South Africa, South African commercial insurance, and third-party insurance in Australia. Last year, they did unbundle their holdings in Discovery and MMI Holdings, and RMI, since we purchased it, has delivered an internal rate of return of 20%. That's over 12.5 years, outperforming the all-share index by 9%. So over a very long period, it has managed to create outstanding value for shareholders. So really our insight in 2011 has manifested. We identified these characteristics ahead of time, and also in addition, it was undervalued at that time. Looking how we have performed in South Africa, what we have done is we've taken a pure South African equity carve-out of the Flexible Fund, and this really gives you an idea how an equity fund could perform. We do think the South African equity fund will be smaller. There will be more nimble, so we'd look to deliver as good returns as the Flexible Fund's equity carve-out will do. So over 3 years, our equity strategies delivered 22% per annum. That's off COVID lows, outperforming the index by 8% per annum. Over 5 years, 12.6%, outperforming the index by 6%. And we have noticed over a long period of time, Centaur, through our trading strategies and investment strategies, have managed to deliver consistent alpha. So this gives you an idea that we can deliver alpha. We've done it in the past, and we expect to be able to deliver it in the future. Just to give an idea, over 5 years, the South African equity general category, which we're going to be in, has delivered a return of 7%, whereas Centaur pre-fees has delivered 12.6%. Looking at South Africa, we are quite a lot more positive. So we see structurally positive signs emerging. So if you read the newspapers, the tone is changing slightly. There is some progress in certain aspects. For example, Transnet signed private-public partnership for Durban Port 2. That was about 3 months ago. In News 24, the manganese rail expansion was completed ahead of schedule. and Kusile is coming online, so the load shedding severity, as we already can see, is less than it was 5 months ago. Also, speaking to GDFI operators, what is apparent, fixed investment is picking up. I think this is quite surprising even to ourselves. So, for example, Wilson Bailey Homes has a record SA order book. Afrimat recently reported their aggregates business is doing exceptionally well. And this is actually a trend we see wider across the economy. Speaking to construction-related entities, there is a pickup in fixed investment. This is very positive because fixed investment is what we need. You know, also there's a lot of works with roads going on and renewables and also water projects. So there is some infrastructure investment going ahead. We think, you know, last 5 years economic growth in South Africa has been very anemic. It's only been 0.5% per annum real. We think in the future it can pick up. So just to give you an example, in South Africa, we're facing major headwinds, particularly with Transnet problems and also the electricity supply issues. But nonetheless, the South African economy is going to grow at almost 1% this year, which is actually very, very credible, I think, and shows the resilience of the South African economy in the face of massive headwinds. So we are looking for growth to pick up from the 0.5% level, and possibly, you know, really be in the range possibly of 1.5% to 2%. I don't think we need further structural reforms to grow faster than that, but we do think growth will be better than the last 5 years. We're also finding some good SA incorporated ideas. There are some mid-cap stocks with good management, good business models, and we think these can perform well in the medium term. Just looking at South African equities, historically very cheap. So the long-term average PE ratio has been 12.4 times. So that's over 15 years. At the end of October, that was at a 25% discount and 9 forward PE. So it's very cheap compared to history. Part of the reason really is the very high interest rates. So what we have found historically is high interest rates depress South African equity returns, and low interest rates turbocharge equity returns. And we've actually tested this over 6 interest rate cycles, and we found this relationship to be very strong. So as interest rates come down, we think interest rates are peaking. We're not sure when they're going to come down, but as interest rates come down, we expect equity returns, South African equity returns, to accelerate. And we think it's a good time to be proactive and get on board ahead of the interest rate decline. So that's part of the reason the market is so depressed, but it also gives you a very good entry point. Just some opportunities. Already some of these are starting to perform. So Altron, new management has gone in and really fixing up the business, giving it new direction. And the star there is really Netstar. It's a subscription business, very strong brand name, and its own intellectual capital. And we think that has got good legs into the future. So you can see on a 12-month forward P of 7.9 and 24 months 6.5. That's relatively depressed valuations. Aspen management have taken really built up the back end to grow. So they've built up a global distribution network. They're adding bolt-on acquisitions, and this, you know, by loading the base much higher, we think good growth can come through. They've also got a world-class manufacturing capability. They're also looking to get outsourcing contracts, and that will also contribute to growth. Reunert, this is very well placed in renewables and electricity cables. So really with the renewable boom, it's going to require quite a lot of cables as well. And it's also got a global, it makes fuses for the global defense industry, and order books are full. So also relatively cheap, a good dividend pay, and we see returns of 20% plus. MMI, Management have taken a number of years to clean up the business. The recent results were very robust. What's really exciting about this is it's trading at a big discount to enterprise value, at 38% discount. And they've got an Indian healthcare joint venture, which is growing very rapidly. They intend listing that, and that alone could be around 50% of the current market capitalization. So we think all these things combined, also it can grow at 20% per annum, return 20% per annum with pretty conservative assumptions. We are seeing slightly more opportunities in the smaller mid caps. So some of the large cap fund managers can't really get meat into these. This fund can. We do have skills. We see management extensively. We're very on top of these companies, and we'll look to exploit these opportunities to deliver exceptional returns for our clients. Just looking at the team, relatively unchanged. What I'm very happy about is we've got a very stable team. That's very important. So Kirsty, who runs our operations, she's been with us 8 years. So she runs operations, finance, and compliance. Very capable, and a great team under her of Megan Morris and Kelly Sue Africa. And Chris does all our marketing and presentations and client communication. Also an invaluable member. The investment team, really headed by myself. Nick has been with us 3 years. He's a senior analyst. He's going to be the joint portfolio manager on this fund. He has been managing the balance fund for a number of months and has really proven his capability. Also, we've got Lang Walker. He's an offshore analyst. PJ Prinsloo, he's an equity analyst focusing on South Africa. He's got extensive experience previously at Ned Group. Mick, he's an invaluable member. He's our trader, but more importantly, our quants analyst. We have developed a lot of intellectual capital. He programs it into systems. We've systemized our process, and he's very, very, very invaluable to the smooth operating of the team. So very happy with the team. We work exceptionally well, a stable, happy team, and also we're looking to recruit more team members just to bolster the capability as we grow. Just looking at our long-term performance, Centaur's been going for over 23 years, and on a net basis after fees, we've managed to deliver 18% returns, outperforming our benchmark by 7% per annum. Something we're particularly proud of, and we're looking to perpetuate into the future. Thank you very much. That concludes my presentation. Please send questions through, but I've got a list of questions, and I'll just address some of them. One of them is, how will this compare to the flexible fund? So this fund is going to be more volatile because we'll have between 80 and 100% equity content. So we're not going to use asset allocation as much. So if there are drawdowns, the drawdowns could be bigger. But I think on the flip side, we expect higher returns because we're not going to have cash, which dampens returns. So I think the returns of this fund can be very high. We would look for, mid-teen kind of returns. And I think because of the lack of cash, it should actually perform stronger than the flexible fund over time. People ask, SA shares have been very cheap for a while, I think, but this is not the new norm. I think they are abnormally cheap now. We think that's really due to the interest rate cycle. So as the interest rate cycle turns, South African equities will perform. And we're also seeing secular changes, which is very positive. We don't have any offshore allocation. This is a pure South African equity fund. And also our view on small and mid caps, I think you have to be very, very selective. So we do extensive work. We also look at the business model, but we do see some attractive small and mid cap stocks. I think one has to bear in mind a lot of these companies aren't that small. They have EBITDAs well over R1 billion, but due to low valuations, they're relatively small market capitalization shares. So that's really a very good opportunity. Someone asked about the world of the property market. I'm not particularly positive. I think, the high interest rate environment globally is not good for property. And also in South Africa, there's oversupply in certain areas, particularly offices. So that's remains an oversupplied area due to COVID changes. Retail is still oversupplied, but that is starting to tighten up, but it's still too early to get into property in our opinion. It's more of a late cycle economic play where economic growth picks up, and then the supply-demand balance turns in favor of, let's say, retail property counters. I think why launch an SA equity fund in the South African, if the South African outlook long-term structurally, policy-wise, and government all seem uncertain? I think, I don't think things are that uncertain, to be honest. South Africa really runs a relatively regimented regime. So our fiscal policy is well known. Our budget process is very well known. The SAR policy is very well known. So it's actually relatively stable. I think we are seeing some structural improvements. I think what's happening is that by necessity, things like Transnet don't have money, that they're looking to embrace the private sector because really there's no other option. And this will lead to better structural adjustments in the future. So we don't think the future is uncertain, and we are positive. And those are those questions. Chris, are there any further questions?
Yes, there's a couple of questions coming through from the chat. With Reinet, if load shedding improves materially in 2024, will that not be negative for them?
Yeah, I think that could be a concern, but it's not. That's not the only business. So it's relatively actually small components. So the electrical cabling, so renewables, large grid area network projects like solar for the mines are going ahead. So those are already approved. So those are going ahead regardless of load shedding. And also they're going to need cables. So they're going to score two fronts on that, but also things like their defense business is doing exceptionally well. And I think that's also a long-term secular growth area.
What percentage of the portfolio would be allocated to small and mid caps? And do you limit the allocation to a single stock?
So we do look at liquidity. So the fund's going to start off smaller, so we can be a little bit more aggressive. So we'll be, depending on the liquidity, maximum 5%. But if the company is less liquid, maximum of 2.5%. I think total small and mid caps. So we're saying companies under 12 billion, probably around 20% in this. So that's something we actively monitor, and we don't want to have too much liquidity risk.
And has your alpha thesis shifted over the last 10 years? Has there been any shift in your alpha profile since 2015?
So ability to generate alpha. So we do look at multiple vectors to generate alpha. So within the flexible fund, for example, we do look to generate asset allocation alpha by varying, and we have done that. So we've done about 1.5% to 2% per annum over the last 6 years. But we're also looking at stock picking alpha, and that's really where this fund will pick up. And as we've demonstrated in South Africa, we've generated about 6% per annum alpha over the last 5 years. So yeah, we do look to generate alpha from various avenues, but it hasn't really changed.
Then, SA Inc., are you also honed in on buying potential takeout delisting opportunities?
Definitely, but I think one just has to be cautious on that. So, because sometimes you see an opportunity and you may wait and just become a stale bull on that. So, for example, people have been saying Adcox is a takeout opportunity. For over 5 years, nothing has happened. So we'd have to buy the shares on its own merits. And if there is a takeout option, that's a positive. So we really buy on the merits rather than purely on the takeout option.
What do you think will be the trigger for foreigners to buy back into emerging market stocks on a sustained basis?
So I think the biggest thing is really the performance of the US market. And the US market has just been exceptional for 12 years. And what that means is people would rather put their money in the US tech stocks. Why venture globally when all the returns are available there? If the returns of the US market, and we think the US market is at a high level, particularly because profitability is so high, and interest rates have also moved up. So we are cautious on US equity returns over the next 10 years. We think if the US starts underperforming, that is positive for emerging markets, and people will start looking wider for opportunities. But also the trouble with the emerging markets, there are a lot of idiosyncrasies. So in China, you have a very strong government. I think people are distrustful of the capitalistic model there. And that's the reason possibly why China hasn't performed better. Russia, is a no-go zone. So emerging markets have changed over the last 15 years. And I think each country has to earn its merits, earn its own merits. So it has to follow good policies and deliver shareholder value. I think that's what's most important. I think emerging markets are a different asset class to what it was 15 years ago.
Another question about why one would invest in SA with a SA equity with a shrinking listing base.
Well, the listing base has been relatively stable. We do have some maybe companies which have been around for a long time that they are kind of got good assets in them. We see some reinvigoration from management. We do see some more dynamic, maybe smaller caps, something like Curo, which has created a base and now starting to harvest the base. So we do see some good businesses here. I think also the declining base of listed companies is really due to the exceptional difficult economy we've had over the last 10 years, but also the very high cost of capital. So in order for that to change, we really need some kind of boom times, and that's when new listings will come on board. But we think we're nearer to the bottom, and prospective returns are good. New listings are more of a late stage and possibly a warning sign that things are overheated.
Do you envisage sometimes where you will hold cash to mitigate risk?
The maximum cash we can have is 20%. So we intend running it generally quite high equity content, about 95%. We just need some cash for outflows and redemptions, and also some kind of liquidity for trading purposes. But we want to run it aggressively and really capture our full alpha generation and stock picking skill. So we don't intend massive asset allocation here.
Your positioning on commodities, given that it is a significant percentage of the local market?
So we take commodities on a case-by-case basis. I don't think you can just say commodities. So we do think a lot of commodity counters are relatively cheap. And, something like African Rainbow Minerals, it's got some good assets, pays good dividends, it's cash flush. We think that's exceptionally cheap. Anglo's by historic standards is cheap. So we do see a couple of good value there. So we will have a fair exposure to commodities.
With the rand on a long-term depreciation record of around 5% per year, and the fact that global economies are also nearing a rate-cutting cycle, with the upside in global equity markets as well as for the same reason as an SA, with less structural problems, why open a fund rather than a global equity fund?
I think, first of all, there's a very large pool of savings in South Africa. The wealth management industry here is enormous. And those individuals aren't going to leave South Africa. So, and one must always be cognizant, if you're living in South Africa, you can't mismatch your assets and your expenses too much, because what happens if the rand strengthens considerably as it did in 2002 and 2003? You can actually lose a lot of money. So you need to be, an investor needs to be aware of that risk. And we really kind of catering for the local investor who's going to stay here. Maybe he's got 30% of his assets offshore, but he really needs to earn South African returns. And we, as we mentioned, we are slightly more positive, and also, Centaur does have very strong skills in South Africa due to our experience and where we're based.
When will the fund be open for investment, Roger?
So the launch date is the 1st of December. So it'll be open. It may take a couple of days to get on the platforms, but that's the official launch date. So if you want to come on board, you need to commit before that, and then put your money in. We'll correspond how you can put your money in to be on the launch date.
Investors can get hold of us, and we'll manage that process.
Yes.
That's it. There were one or two other questions, but we'll respond back privately to those people. And otherwise, that's it for questions, Roger. Okay.
Thank you very much. Thank you very much for your time. We're actually excited. Centaur's launch is investing in this fund a considerable sum, and we think it's going to be a great performer. So we'd love you to come on board. Thank you very much.